Hi, good evening, everybody, and thank you so much for joining us. We promised that we would do this webinar monthly. I have to confess that this time we have made it through the skin of our teeth. You can't get better than 4 o'clock on a 31st to kind of claim that yes, I do this monthly. So apologies for doing it so late, but as you know, we had decided that with the number of webinars, conversations about markets that you guys get to hear in the first 10 days of the month, sometimes it's useful to hear a voice at a different point. Since you've left it this late, I think in some sense we have the honor of delivering our first outlook looking forward into November in the industry. Uh, but like I said, it's not a choice. It's just Diwali vacations, etc. So I must start by belatedly wishing everybody the festive season wishes, and I hope that for you and your families, the next year is as prosperous as possible. I won't spend much time. As you remember, a couple of months ago, based on feedback from many of you, we had talked about using certain monthly webinars to do a deep dive into certain of our products so that it helps each of you understand what we are doing with those funds a little more and understand what we are doing with those funds from a client's perspective. So we are reverting. This is the second time we are doing that. We've had a very interesting month, right? I mean, I was just looking at the data. And interestingly, the 1 month return typically broadly across equity funds, the 3 month return and the 1 year return are mota moti the same, right? So effectively, you could argue that whatever investment you have taken or jail out over the last 1 year, उसका पूरा return एक ही महीने में आया है, वो भी last month. And conversely, if you think about it over the last 3 months, when you have a, let's say, a period where August nothing happened, September nothing happened, human psyche starts to become more negative thinking. Ki boss October also nothing will happen, and if at all it may get worse. And I think the reason I'm talking about it in this manner is I think October is a beautiful reminder to us why not to think short term. Because just when people start to create, but I would say, thought processes around range bound market, we don't know where this is going. Equity markets kind of turn around and give you a knock on the backside saying, I will do what I have to do. Don't overthink and don't try to predict the short term. Now, that's not to say that I'm kind of predicting that this is the start of another fresh rally or so on and so forth. I think it's just a perspective that uh, increasingly after 4 or 5 years of positive annual equity markets, we must be much more prepared to have markets that will become much more challenging to think about short term. And the only holy grail or the truth that will be useful for clients will be that if you're staying invested for the long term, that's what will make you money. Uh, so I think conversations around which cap looks good at this point, which theme looks good at this point, uh, which style looks good at this point. I genuinely believe that anyone who gets caught up in that debate or thought process is likely to lose oneself in things that eventually will not matter in the long term. What clearly seems to matter in the long term is India is a good story. It's a story that will take time to play out over the next probably 4, 5, 7 years. And that's what one should think about. Having said that, just as a precursor, I have been coincidentally 9th of October. I passed 30 years in this industry. I started in this industry way back 9th October 1995. So 30 years I've been across many mutual funds. I survive till I get kicked out in a sense. But I have to say this that in my travels, and some of you may be on this call, I'm guessing. So I have never got so many questions on gold and silver in the last 1 month compared to the last 29 years and 11 months of my career. मतलब 29 years and 11 months में जहां भी मैं जाता था to discuss about markets, funds, performance, so on and so forth, जितना क्वेश्चन वाज स्पेसिफिकली ऑन गोल्ड एंड सिल्वर एज एन एसेट क्लास, उससे 3 गुना मेरे को लास्ट 30 डेज में आया है. And honestly, I've told people that I've realized that actually it is much, I mean, in order of priority, and Krishna may upset at me for saying this, but I said, I'm now getting I'm getting a belief that the easiest thing to start predicting or giving a view is equity. The next most challenging is fixed income. And then the most challenging subject is gold and silver. Matlab, it's really, really difficult, right? So, in that sense, I thought it will be a good idea, even though we said we will use the opportunity when we do specific fund deep dives, we would do one fund at a time. I thought it will be very opportunistic for Rahul to come back and talk about multi asset. Because, like I have spoken to many people on my travels in the last 1 month, rather than worrying about, or discussing to death कि gold silver run up हो गया है, करना चाहिए, क्या लगता है, best solution, like we've been saying actually on this webinar for a long while now, is that multi asset should now become a core fund holding of every client's portfolio. And I'm going to go out on a limb and say this, that perhaps 5 years from now, when we do this webinar, people can hold me to it. That I'm now become convinced that if there is one fund category or one fund that should be 10% of a investor's portfolio that they can hold forever, it is multi-asset. There is no other fund that has the same ability to make that claim. And I think it's just because in the last 3 to 6 months, we've seen that play out. The interchange between equity, fixed income, gold, and silver, and the opportunities at one hand and the challenges. And I think you'll understand from when Rahul is discussing it with you in terms of how we've run the portfolio. Uh, there are very, very nice ways to generate almost decent returns, but by taking significantly lower risks, because you are able to play across asset classes, which is why I think it makes it such a good proposition. So again, rather than thinking gold करना चाहिए, silver ETF करना चाहिए, FOF करना चाहिए, if you have 10% in a multi-asset fund, by and large, typically you've got 2-3% of your portfolio, 100 rupee portfolio, in gold and silver. And if you keep that consistently, it takes care of itself. I'm just suggesting 10 as a starting point. Quite frankly, it can easily be 20. So I'm going to, that would be one thought process. The second thought process is, I think, the ability in the world where people are saying X percentage of funds underperforming the benchmark, etc., etc. And then the question is, how are you justifying your existence? And I'm saying this I don't mean to be rude, but I would say that's true for everybody on this call as well, right? अगर client हमें पूछे या आप हमको पूछेंगे कि भाई, why should I give you money? Why should I not just blindly put in an index product? It is because you will say that because I believe in the long term, I will add value, right? And that's true for you on this call. It's true for us as well. To my mind, if there is one equity product within the entire mutual fund family where we are really saying this is what giving us money versus passive should mean, because it is the test of our convictions, it is a focused fund, right? Because it is supposed to mean whoever is running it, they are limited to choosing only 30. भले आपको 50 स्टॉक अच्छा लगता है, भले आपको इतने सारे सेक्टर्स अच्छे लगते हैं, it is the true test of conviction, right? And so, to my mind, what you're really paying in terms of regular plan fee is you're really paying for our conviction, right? The conviction of each of our fund managers. And so I thought it'll be a good opportunity, especially in these markets, to talk about a fund that I think has been a very silent superstar in our own family. Frankly, over the last 3 to 5 years, people have argued जिसने small cap, mid cap का exposure लिया उसका तो चांदी हो गया, and pun is not intended. But the reality is, you'll find that how Krishna has run the fund. It's quite crazy to think that the fund has generated almost similar returns to most of the better multi-cap and flexi-cap funds around, including some of the mid-caps, including ours, with a 65-70% allocation to large caps in that 3-5 year period. So I wanted Krishna to talk a little more about how he is managing the focus fund, because I think it deserves more attention from all of us on this call. So I'm going to stop here. I just wanted to set the context, and I'm going to now hand it over to Rahul to talk about the multi-asset, and then I guess Krishna will talk about focused, and we're happy to answer calls. Thank you. Rahul, over to you.
Yep. Yep. Sure. Thank you, sir, and good evening, everyone. I'll just open the presentation. It's a very short presentation, and I hope the presentation is visible.
Rahul, it is.
Yep. Yeah, sure. Thank you. So this is some of the basics of multi-asset as a category, and then I'll very focus on what we have been doing in the multi-asset fund of ours. Uh, you know, this is kind of our starting presentation always, which says the enemy of a good asset allocation is the quest for a perfect one. Fight the urge to be perfect. Over the course of when we are figuring it on our model, we are always trying to build in the best possible or the perfect asset allocation. And when I was looking at the iterations, we'd actually focus on certain other models beyond what the current model is, with the idea is let's seek the perfect. And yet we understood one thing: never make good the enemy of best. So what we believe is the model of asset allocation that we kind of figured out is a commonsensical model, and it relies on the principle of being broadly correct than being precisely wrong. And it's a very important distinction, to be broadly correct than be precisely wrong. And that's what our allocation models have always attempted to be: not to be the best, but be good enough to take care of the market circumstances. uh, just one of those The introductory presentation. It's a hybrid taxation, meaning after 2 years of investments you get the 12 and a half plus the cess, etc. Equity exposures from 35 to 80%. Debt is between 10 to 55%. Units of gold, silver, and other commodities between 10 to 30%. And units issued by REITs and InvITs 0 to 10%. The units, etc., of REITs may change as we go along, because SEBI has come out with some guidelines on REITs and InvITs. We'll figure it out as it comes into in a form of a circular. But that's a broad overlay. We were one of the few guys to launch a hybrid taxation in 2024. The idea was, in a multi-asset fund, it allows at that point of time it was a 3-year taxation benefit, and 3 years was also a good enough patience capital for multi-asset to toggle within asset classes. So while it has been 2 years, but I would like to still believe that 2 to 3 years is a good time for asset allocation changes, and I'll tell you why, and I can show you how we did it through the period of time for the last 1.5 years when we have been launching this fund. I'll just skip this one. Okay, so this is a broad thought on every asset class, and I wanted to be very specific on this, and this needs some thought. In all asset classes have a very cyclical pattern of returns, and no asset class has been able to be, you know, haven't have got away from this pattern of returns. The pattern of returns are usually very sine wave curves, what is called the sound wave curves in physics. There are periods of exaggeration of returns, both on the upside and downside. The exaggerations may be price based, that is, very high or low returns, and can be price and time based, that is, high return for long time or a low return for long time. And also there's a mean return of the asset class. The return to the mean is also a very ironclad rule of the market. Every asset class that I have tracked goes through these cycles, and asset allocation models tries to embrace these cycles. That's the core. The belief that asset follows a pattern of returns, and there can be exaggerations and mean reversions. And the last point, which we almost tend to forget, is returns of every asset class is a finite asset class. Yeah, is a finite. So there's nothing called infinite returns. Uh, when you apply the concept of finite to commodities, it becomes a bit tricky because there are no cash flows attached to it. But theoretically, Assets which have cash flows attached to it have some sense of finite returns. But that's essentially a thought process on all asset classes. You can't escape these as you run through the cycles. So, what are the core principles of asset allocation? The core principle is between equity and non-equity. We consider the earnings multiple of the equity index, which is Nifty 500 or benchmark, and the 10-year sovereign benchmark. And we look at the ratio between them and have a asset allocation model, which is internal to us, which decides the asset allocation. But what is also important is to be an effort to be a true label multi-asset with allocations which are based on potential future returns, not the past returns. So it's very essential for us to have asset allocation based on the potential future returns. And we also remember, as I said, the fact that the model does not seek perfection. The model seeks the goodness of it. And where do we significantly underperform broad equity markets? One, it's an asset allocation model. It should not be, used only against broader equity, but we just, looked at the periods when models had its underperformance. One is a very secular, strong equity market performance over a short to medium term, because the models tend to, underplay equity at that point of time. We will tend to underperform. That's what we the funds had witnessed between April to September of 2024. Market dislocation, like COVID or a GFC. And typically in a COVID, because we run on earnings multiples, in a COVID situation, the PE had shot up because the earnings was coming through the COVID. The PE had shot up. We are aware that the dislocations can trigger a bit of a challenge in the models. But let's remember the fact that there's a market dislocations, a GFC or the 2008 financial crisis or a COVID. Those are exogenous, extreme exogenous conditions which can trigger a market dislocation, which can trigger some look through in in our models. And third is behavioral biases, where you stop disregarding models to say the fact that I think the model is wrong. But we've listed this as as a potential uh, reasons for our models to underperform. These are generic things, not very specific to our own model, but most of the models would probably start looking bad in these three circumstances. So, I mean, if you look at if you look at our dynamic equity allocation that we have through a model, it's very important to look through when we launched and where we were, in September of 2024 when market had peaked out. Our equity allocations based on the model was close to 35%. And when the markets had fallen to in February of 2025 to March, the equity allocations had moved up to 50% plus. Now we were close to 55 to 60 at that moment as the markets were recovering. The most important thing is we were one of the few fund houses who actually changed allocation. We actually almost moved up allocation by 50 to 60% of the existing allocation. We would like to believe that we are one of the few fund houses who have managed to so dynamically change the risk allocation between equity and fixed income. And what is more interesting is at that point of time, fixed income had been suggested at X of 35%, the fixed income would be close to 40 to 45%. And we had actually gone long on fixed income. That is, interest rates were also at it was not a high, but it was a good enough level. And when it had suggested a 40% debt allocation, which also normally suggests the fact that you should go very high on duration. So we captured the fixed income fall of rates also through when it suggests a higher allocation. The model usually means you have to go very long on GSEC, which helps you capture the duration benefit also. So this model actually worked in a beautiful fashion, limiting the equity downside and capturing the fixed income upside when it mattered the most. So I think uh, that's what has been the highlight in the last 1 to 1.5 years, where it kept on toggling between equity and fixed income in the sense of where the future potential return earns, and to capture a part of the upside but also prevent a large part of the downside. So that was the way the model had worked, and these are the actual equity models with the equity allocations with the numbers on the blue line depicts the index numbers. So it just shows how we have changed our equity allocation through the period of last 1.5 years. And if you look at this, and this is just summarizes our allocations. In September of 2024, we were at 38%. Equity moved up to close to 50% plus. The debt started falling from 40 to 20, and you know interestingly, we'll talk a bit about gold and silver. At the end of September, it was close to 18 to 19%, close to 19%, and we had actually increased our REITs allocation from 3 to 7 to 3 to 8 at the peak. And I'll also talk a bit about REITs. And then we also started paring down our exposures in REITs as we captured a large part of the large part of the upside. So what we also wanted to stress upon the fact that in our initial presentations, we had talked about a true multi-asset fund. And if you can look at the range of dispersions of asset classes that we have through the last 1.5 years, it's played the, as I call it, true to label, shifting asset allocations when it matters the most. A bit on gold and silver, I'll just leave aside the thought that we're close to 19%. Uh, but at this moment, as I speak, because it has been through the month, in the presentations, we'll talk about the gold and silver. But you can be rest assured that we started pairing our exposure very close to the peak. Uh, and as I talk today, we have significantly paired our exposure. And because of regulatory constraints of making it a minimum 10%, we have significantly paired our exposure to the regulatory levels permitted at this moment. That's what we have done through the month at this moment. It was a play on capital appreciation plus regular income. We had increased our stake significantly in a REITs from a 2% to an 8% before we started, and the REITs as an asset class had done significantly well also at this point of time. And after we thought that we'd captured the future potential returns started decreasing, we also started decreasing a bit of exposure to REITs also. Uh, some thoughts on silver and gold, which we'll just talk about. We all know this story about how silver came into the mainstream. People had talked about Saudi Arabia investing in silver ETF. The US government added silver to its critical minerals. But let's also remember the fact that the key question to always been asked is when, I mean, I can talk about the good things of gold, can also talk about the good things of silver. Fundamentally, the key question always has to be asked, is it in the price or not? And I think that's something that we keep on asking ourselves when we run a multi-asset fund. Is it in the price? Is it in the price? That's a key question that you have to keep on asking ourselves. And through the charts, I will try to show you just because we don't get, it's very easy to and seduced by stories around gold and silver. But let's also remember the fact that since there are no cash flows attached to it, it's very difficult to have a sense of potential future returns. And we also get reminded by the fact that if you ask about critical minerals, lithium, which is a very critical mineral in the EV space, is today at almost at 20% of its 2023 highs. Coal is also at a 20% of its 2023 highs. So, like a commodity behaves in a very cyclical fashion. The movements are swift, and we have to be aware and embrace that uh, there are fundamentals attached to it, but there's an element of price volatility to it. Let's not even deny ourselves the idea of no price volatility in a secular movement. So you'll have to run through this course when you run a multi-asset fund. So we just wanted to present a long-term chart, from 1975 on a silver, the volatility attached, the Manhattans which came in, the skyscrapers which come in, the skyscrapers which kind of defy gravity initially, and then again cater down. So I'm not even suggesting that we're going through this, but let's be aware that in a long term, silver behaves exactly it should be behaving a commodity. Now, commodity which has its own industrial usage, a commodity which has its own speculative usage, a commodity which is as a poor, unfortunately poor cousin sometimes people refer to as of gold. But let's also remember that in a long term story, this is what the price charts look like. And similar with gold also. In the long term, let's look at what gold has been and where we are placed now. It's just a remembrance of the fact that it can be equally volatile both on the upside and downside. And as I keep on reminding myself, the 5 year. So let's imagine for ourselves the fact that you had invested in a dollar silver, because this is the reason I'm talking about dollar silver and not an MCX silver, is that they don't have a price history. It's a price history beyond, it's only after 2005. This is a long-term silver, dollar silver price. the finite pool, where you are in the market at this moment, where are you at a price exaggeration zone? Probably the answer is yes. Are you at a time exaggeration zone? Silver has enjoyed a major bull run between 2005 to 7, between 2010 to 11, and it's not a time exaggeration, but it's a price exaggeration at this moment. And a 10-year silver SIP return. But also, let's always have this, you know, believe in ourselves, with that between 2016 and 19, people forget that had you done a dollar or a silver investments between 2005 and 2010 in silver as an asset class, between 2015 and 2019, that same silver would have returned you 0 to -5% on a dollar basis. An Indian rupee is a bit of worse than this. So it's just a humble reminder of the volatility of the asset classes, and the fact that today you're at a price exaggeration. And when I mean by time exaggeration, it could have potentially been at a, in historically it has been seen that it can potentially be go a long way. Very difficult to predict, but it's almost at the top end of the return charts. And similarly with gold, I mean, I'm not even denying that. One of the things that we've been very cautious about, the reason between gold and silver also is, despite all our bullishness, is the fact that while we have paired our exposure, is that gold has worked exceedingly well when gold and silver and its poorer cousin silver has done exceedingly well when dollar index falls, exceedingly well. And if you look at broad, charts on gold versus dollar index, you can see establish the clear linkages. And dollar is also making is a mild comeback. So, so we are watching out for dollar index. It has moved up from 97 to 99, and dollar or any rise in dollar index can be a potential nemesis for both gold and silver. Sorry. So we're just looking into that very carefully at this moment. A bit on gold and silver. The biggest con for us at that point of time, and every point of time, is at this moment, everybody seems to love it and want to buy it. As a behavior, we will be very, very cautious on this. Uh, on the positioning side, so at this moment, broadly, the equity portion is at 55 or 56%, between 55 to 60. Debt is between 15 to 20%. Gold and silver, as I said, the fact that we have significantly paired our exposure towards gold and silver. A bit on equity positioning is, while this is the equity portfolio is managed by Ranjit, a large portfolio is a large cap biased with a 39% allocation to large cap, 6% to mid cap, and 10% to small cap, which makes it a total of 55 to 56%. Is overweight on infrastructure, auto and cement, underweight on consumers, BFSI and IT. Debt, something that I run, we are at a 50-50 mix between sovereign and corporate bonds. Mostly the duration is dynamic. Well, at this point, we maintain a very modest duration, close to 2 to 2.5. And most of it are corporate assets, rated AA plus and above, signifying very healthy underlying credit. And that's it from my side. I will leave it to Krishna. I will stop and leave it to Krishna, and we'll take the questions thereon. Thank you for listening.
Yeah, thanks, Rahul, and good evening, everyone. As Anthony mentioned clearly, doing this call on last day of the month. Hopefully, it's been a good month across asset class. So it's possibly a best way to communicate some thoughts on markets as well as what our focus fund positioning possibly is. I'll start with the presentation. I think it's visible, right?
Yeah, Krishna, it is.
Yeah. So very broadly, let's look at economy and markets in two different contexts. Yeah, some of these things, one can run through fast in terms of reading, but the primary issue facing world as well as India is really the tariff uncertainty. Potential India-US deal is on the horizon is what we've been hearing now. Whether it happens maybe by end of today or within next 10-15 days is more looks like more a question of time rather than no. The only big change, if I have to really highlight, is that when this tariff announcement came somewhere on 2nd April or so, prima facie there was the first point of conversation or the assumption really was that China is going to have a little bit of a tough time negotiating with the US, and the end objective of a lot of this tariff related activity from US is to start having a alternate source of production etc from China. But how the events have actually evolved over last maybe 7 months or so has actually led to a situation where possibly China got its chance to demonstrate its own way of negotiating through their own strong points. And somewhere as of now, what we read as of yesterday evening rather, was that the tariffs are broadly on hold, etc., from US side. So let's see, in light of that, a lot of assumptions surrounding the world economy possibly, which were made in April or so, possibly may or may not hold good in near term. But at the same time, some of these things, tariff being on hold for a year, things can again come back. Come to pure play India, I think what we've done in the domestic space is what we can possibly concentrate on as a tariff really lies outside. We got two nice things happening. The budget had an income tax reduction, so that supported disposable income for people. GST rate cut announced on Independence Day and implemented from 22nd September really has changed the price point for quite a few products. At every price point, there is some price drop and makes it more affordable. So if you have a combination of more people money with people because of tax reduction, and more affordable or more cheaper the products, I think mass consumption stimulation is a nice assumption. We've got these early signals from the 22nd September, maybe till this week or so. We get the data confirmation somewhere next month, as and when the GST primarily, and let's say maybe tomorrow onwards, the auto sales data comes in. We'll basically get a clarity on what sort of incremental change is done to volumes. Early indicators are all positive. The core policy of this government has been on capex and infrastructure cycle, whether you call it PLI schemes or Atmanirbhar Bharat, or sheer improving the transport connectivity. I think those remains intact. That's a good part. So while with all this focus on consumption, they've actually introduced some more schemes for electronic manufacturing, semiconductor, etc., so that remains. RBI again very supportive on both lower rate and higher liquidity combination, which is the ideal thing for an economy which is somewhere around 6.5% annual run rate right now, looking to go to 7.5. You need both. You need availability of money, and as well as cheaper rate. So that's supportive from there. Crude oil price really helping. GDP has been good. First quarter, quite a surprising outcome in a way vis-a-vis market expectations. But yes, it's good. And going ahead, this GST cut is likely to stimulate a lot of changes on consumption pattern, and that's where the growth comes in. Corporate capex in a way will comes in once this consumption takes place, and utilization of capacity creates corporate confidence for fresh, let's say, demand and fresh capacity creation. Come to pure markets, valuations are very favorable with this time and price correction which we've seen. Earning recovery, we've had a reasonably, let's say, muted last 12 months in terms of second half FY25 as well as the first half FY26. Though some result, part of the result season is pending. But again, the GST cut can be one of the primary, benefit, as well as some sort of a low base last year uh, can help this change in earnings growth rate for next 12-18 months period. uh, Financial markets always thrive on some underperformance being caught up vis-a-vis sectors, vis-a-vis stocks, or vis-a-vis markets. In this case we're discussing countries and emerging markets. India has had an pretty much we've been stable, while the entire world has possibly delivered quite a good set of returns in last 12 months. So this relative underperformance, what we possibly believe we have now this potential to catch up, especially look from FPI eyes, because they look at countries from a relative attractiveness, relative valuation. So for the same FIIs, which India was relatively expensive 12 or 18 months back, possibly it's no more that expensive, or perhaps more attractive, based on which alternate country they were evaluating as a part of this comparison. From a market view perspective, large cap remains fundamentally attractive, but mid and small caps are driven more by liquidity flows. It's actually no way to assess the liquidity flows, in the sense that India is a growth economy. The core principle of India is reasonably similar. We are more or less likely to grow at 10% odd, or 10 to 11% nominal GDP growth rate. The income distribution in hands of people is going to create disposable income, as well as investment surplus. The surplus, one of the best way to invest possibly is when equity markets, as shown by rising participation in last couple of years or last 3 years. So that flow I will not discount. In terms of the flows can still come into mid and small. The only alternate thought I can share is the equity supply, through these IPOs, OFS, QIPs have matched the domestic demand at least in last 12 18 months, which have really kept the market gains. This is a picture actually from ET Today cover page. Not many of you would have missed, but still highlighting the sheer amount of money being raised by Indian corporates, as well as the promoters of those companies, either fresh capital or of a for sale combination is pretty large. And that's the thing. So the table on the left side actually is the calendar year data. The picture on the right side actually is financial year. So that's why you might see some numbers not mapping, but they've just tried to show details on both the front, financial year and calendar year. But the macro message is that too many companies are raising money somewhere. That rising supply of paper has come to meet the rising demand, and that's why possibly last 12 months not much money. There's one of the variable which we also in let's say evaluate, because at the core the economic growth is capturing by earnings, but the valuation does capture some of those variables. From a strategy perspective, as a large cap remains fundamentally attractive. So yeah, prefer large cap space. Just to admit, some of these things are more applicable to funds which have a reasonably open mandate of large cap, mid cap, small cap. Wherever we have a mandate to be, in a mid cap or a small cap in a particular minimum percentage, obviously we do go by those mandates. So there are also selective bottom up stocks picking helps. Yeah, earning is what we're tracking, and that's where consumption in a way comes up as a nice category of earning growth for next 12-month visibility, because of this partly GST growth rate and partly GST cut, and partly in the overall consumer buoyancy that tariff deal with US remains critical factor to monitor, because some of these choices on sectors and stocks can have a review based on what we understand once the deal comes out. Like today what's happening is that for many companies with focus on US as the export market, either for products or services, have a visibility which is honestly not so great today, with the kind of tariffs being imposed on at 50% tariffs. Not too many products end up becoming a viable purchase option for a buyer. But as we've seen for too many countries, the original tariff rates have been revised downwards as a part of the deal, and one does expect that in the Indian context also, the tariffs being imposed currently are under review and would be coming down. So having said that, let me share a little bit thoughts on Focus Fund. Our journey so far, we launched this fund in November 2020. I mean 19th November 2020 precise. So we are about to complete 5 years. Sharing some thoughts on our journey so far. A little bit of a retrospect, and at the same time, uh, the core thought remains, that financial markets and fund management in financial markets remains dynamic. There's no reason to believe that the way we manage the scheme can continue same, but just a retrospect of what's happened till now. And I'll also share views on markets as such, but that's already so it's broadly managed in a blend style with a value tilt over the cycle. Been a large cap oriented with select small and mid caps at various points of time. Uh, as policy announcements kept on coming from government side, one belief really has been that if India has to really become Atmanirbhar Bharat, that there's a need for capacity expansion across the infrastructure assets. We can call it, core economy or physical economy. The belief really is that if India is going to be Atmanirbhar, and we're going to import, increase our share of either import substitution or export potential via these PLI schemes, will need more and more of domestic production of commodities, domestic production of, let's say, steel, aluminium, maybe oil, uh, electricity, because any manufacturing activity taking place in India will require each of these variables. We can't import electricity, we can't import steel, because if we import steel, then eventual the underlying aim or objective of Atmanirbhar, or doesn't really play out, because you are still left at mercy of ability to import goods, etc. So our belief has been, government of India, the way they are doing PLI by way of supporting various electronic manufacturing, etc., pharma, automobiles, etc. There is a reasonable roadmap, for companies in who are going to cater to this demand through maybe steel, maybe oil, etc., power, electricity. So that's been one thought process implemented in the fund over last 4 5 years. At various points of time, some stocks would have entered and possibly exited based on the valuation, etc. But that's been one thing. So outperformance of real estate is been a key theme in the fund. Why I'm repeating, possibly it's been journey so far, but at the same time, cognizant of valuations, and looking to respect those, saying that if required and whenever some alternate opportunity exists, we do look to change a little bit, focus maybe away from this real estate into something different, maybe financial assets, maybe digital platforms, etc. So that's been part of the thought process. When looking at focus as a fund, one of the thing which I've been looking to manage is there a way one can capture the re-rating of stocks and sectors rather than relying solely on earnings? That possibly is a part of this value tilt. Because in a value tilt, you're really not buying a company for just for earning growth. You're buying with a belief that this company will continue to remain a earning growth driver, but something is likely to change the valuation multiples, and that catalyst can be anything, can be, let's say, policy making, can be promoter action in terms of new growth plans being announced, or sheer near term demand supply dynamics of industry undergoing a change. This is a nice snapshot of Morningstar, how they capture the style of the fund in terms of past data. uh, Broadly, it's in the blend, as it says. And the very fact, we have a nice growth quadrant there. It also conveys that fund has not been averse to taking exposure to growth areas. It's just that the belief is, once you start adjusting for valuation, some of those growth opportunities might make way for a value opportunity where we believe there is a catalyst, and that catalyst can actually capture the the re-rating potential is there. If I look at market cap trend, largely biased towards large cap segment, as shown by this area graph. But yeah, vis-a-vis the entire last 5 year cycle, maybe the fund is sitting on the highest amount of large cap exposure as a percentage to portfolio, partly conveying the thoughts on the markets. But at various points of time, as this graph shows, we're not being shy from taking a good small cap or a mid cap exposure at various points of time. Cash is broadly not really, I say average cash would have been just about 2% in the fund, and that's not really a strategy, for managing money. It's just some sort of a minimum requirement, etc. But otherwise, I do believe, when one is looking at focus fund, thought on large cap can remain similar. At the same time, all it says, I can just say that right opportunity will not put a constraint on saying that I'll not cross s- as exposure to large cap below a particular number. That's something not really the idea. It's just question of integrating valuations. Another challenge in the market in last 3 years has been that in the Indian equity market, the way we categorize the mid cap as a category, we have only 150 stocks in as a investable universe from a mid cap definition perspective. This naturally puts some sort of a restricted number of companies eligible, and by default, when more money flows there, some sort of valuation excesses can happen in some of the pockets. And to that extent, maybe the fund may not have bought too many mid caps, but as I said, pretty open to evaluate more and more ideas. This is the sectoral trends of how some of the top five sectors as on date have played out over the cycle of last 5 years. Maybe financials usually has been as the largest position, but yeah, with a reasonable volatility within those spaces, what this particular chart conveys. This is the top sectors holdings, stock wise as well as sector wise, vis-a-vis the benchmark for sectors for September 30th. I can say no material changes, but I'm sure once you see the portfolio fact sheet for October, there'll be some changes. Some ranks would have moved up and down because of some portfolio actions, etc. This is, core thoughts on let's say how fund is possibly positioned in terms of right now. Incremental view remains that yes, we have this next, let's say, couple of months looks interesting. This is typically one part of the cycle of the year where a lot of global funds look to rearrange the portfolios to they typically reshuffle as asset allocation. Remember Rahul and Anthony both mentioned about asset allocation being the key where they do try to capture valuation. So similarly in Indian case, valuations of India has become quite attractive, and we do believe that allocation change can come into support some sort of flows back into India from FII perspective. Or just maybe a couple of more slides. So this talks about how the fund has performed over this cycle, maybe 1 year, 2 year, 3 year, and inception is as good as let's say 5 years. How our focus fund has played out vis-a-vis the benchmark, and partly the category average and median on both the returns as well as volatility. That's been possibly the endeavor in terms of trying to see if fund performance can be matched with lower volatility on the same. It remains this. That's the normal disclaimer we used to. And yeah, let's talk, I guess, because any conversation which you all want to have between Anthony, Rahul, and myself, happy to.
Yeah, thank you, Krishna. And let me start with we did get a couple of questions fairly early on to the conversation. So some of it could have been answered, but I think let me just start with some which I've not for sure. Mr. Banerjee asks, would be great if Mahindra Manulife could come up with a domestic REIT fund. To Mr. Banerjee, that is very unlikely, especially now. In the past, it would have been unlikely because, frankly, there are only about 4 or 5 REITs that you can buy, and the liquidity within those REITs is such that to have a fund which is 100% owning that and be able to provide liquidity would have been a challenge. Now, as you know, the regulator has taken a stance that REITs are to be classified primarily as equity, which effectively means that you will have to wait for regulator to create a new equity category. Alternatively, one can look at, will there be potential thematic funds which will have exposure to, let's say, real estate and construction space on direct equity side as well as REITs? Maybe, but I still believe we are 3 4 years at least away where there are enough REITs and enough liquidity in the REITs for anybody, including us, to be able to create a fund where I can be very comfortable that open end liquidity is possible. So it will take some time. And I understand your frustration that our current Asia Pacific REITs is closed for subscription. Uh, but just do bear in mind that it's been around for 5 years. For 4.5 years, actually, it was available for subscription. And that's the irony of life, right? When it was available for subscription, there was no real compelling reason to invest. But unfortunately, because of the quotas, while some people are looking at, you know, uh, looking at real estate investment trust a lot more, then even our Asia Pacific REITs would have been available and nice, but it is what it is. I see two questions, and I actually, honestly, slightly surprised by those questions. Why did we stop with our metal? I'm assuming that means gold, silver allocation at 19. Why not higher? Just bear in mind that what you see in the fact sheet is the allocation at the end of the month. We do have the flexibility to go higher. That being said, also remember, because I see the other question ki why we don't look at moving 10 to 25 to 30%. Hindsight is a great teacher. Just to give you clarity, from the internal work we do, we have perhaps within multi-asset had amongst the highest allocations to gold and silver in the industry, and certainly within that the highest allocation to silver as a percentage of the total allocation, in fact including absolute. uh, if you remember, those of you who remember our NFO launch of multi-asset, that was the basic point we had met. Key hybrid taxation gives us the flexibility when we want to go overweight in fixed income meaningfully or gold and silver meaningfully. I think the last 6 months has. It's not a coincidence that the top performing multi-asset funds in the last 6 months to a year are all the multi-asset funds who have hybrid tax. And you would remember my statement, tax should come second, first should come return. And a lot of multi assets that have the equity tax treatment do not have much flexibility, even if there's an opportunity. So, fair to say that please think of multi asset as a product that is trying to, I would say, deliver. I would say within the hybrid category, I think it's the most superior risk return product, right? The kind of return it is able to deliver and the kind of risk it takes is probably better than equity savings or balanced advantage, to be perfectly honest. Aggressive hybrid is perhaps different because I believe aggressive hybrid is a great product for people who are worried about whether I should invest in equity, even if I have long term money for the long term. Typically, our answer to such clients is, sir, आप STP करो. My solution is आप aggressive hybrid में डाल दो lump sum. That should automatically take care of any volatility that you may have in your mind that will happen over the next 2, 3, 6 months. So it's not like we cannot go to 30% or 25%. It is not that we have not crossed 20%, but what you see is at the end of the day the fact sheet. And as Rahul alluded to, because it is the 31st and our numbers are not out, our gold and silver allocation is a lot lower than 19% as we speak. So we do have a view that gold and silver, at least in the short to medium term, has run a bit of its course, and we would prefer to be cautious at this juncture. Uh, there is a question from Akhil on which I think Krishna would have partially alluded to. How do you see mid and small cap at current level? Also, a view on IT. Krishna, I'll ask you to talk about IT, but I just want to give this. See, understand we run different funds, right? So we run a small cap fund, it run a mid cap fund. Jaju, who runs the small cap fund, or Kirti, who runs the mid cap fund, for them, they are looking to get the best ideas within small and mid cap, right? So, uh, and their view will always be that there are opportunities, even at any level, there will always be valuation opportunities, there'll be growth opportunities. Within most of our other products, we are today taking a view that between large, mid, and small, there is very little to choose, right? And when there is very little to choose, sometimes valuation comfort gets the largest priority. And that is why a number of our funds are probably a little more large cap biased than they have been for the last 3 to 5 years, including the focus. That is not going to mean that mid cap and small cap can't change allocation in our multi cap and flexi cap funds in the next 3 to 6 months, because we've always held the view. Think about investing in Indian equity for next 5, 7 years. Anybody deciding to make a call small versus large versus mid is spending more energy on what's not important. What is really important is what is the allocation you have? Is it the right allocation? But Krishna, on technology, because that's obviously been a sector that hasn't done well. I know from our internal conversations, it's reaching some sense of an inflection point because of valuations, etc., etc. Any thoughts on IT? And I would just encourage anybody else. I mean, please post any further questions on chat.
It's on IT sector. Clearly, there are becoming a very good value picks because of the valuation the way they are. One way to look at some of these companies, they are right now operating a little bit lower than their ideal capacity utilization. They are somewhere trading at around 4.5% kind of free cash flow yield. None of them have any debt, so they are all available at a very nice inflection point from a valuation angle. What's missing perhaps is two parts. Is there any implication of this tariff issue which may spill over to service sector, and perhaps the how US economy is picking up or is taking shape? If I look at US economy conceptually, yes, Fed is doing all the right things. They've also reduced the rate as as late as day before yesterday. So to an extent, they're trying to stimulate their own economy through monetary policies. For many of the Indian IT companies, anything between 40 to 60% kind of revenue comes from US markets. So to that extent, anything happening good in US economy is actually good for IT companies. So one of the comment I did mention, as a part of that um, view outlook was that look monitoring the trade deal, so that can help rebalance or reorganize some of this portfolio into a slightly different weights or different name of the stock on the portfolio. Last part on IT, which is the conceptual worry coming from some quarters saying that in this world of AI, does there pose some sort of a business challenge? Two comments. One is a bit early to really think that can AI completely change or disrupt the business model. At the same time, if you look from a pure opportunity angle or what companies are doing, they're doing their own bit in terms of implementing their own version of AI within their own businesses to serve customers. In the early phase of AI implementation, they will actually get more business from clients because those clients who wants to implement AI will also need some support. So that's the broad thought on AI, on IT as a space. Looks attractively valued. If maybe that little bit catalyst is required, and that's what we're trying to search for to go really over it.
Okay. There's a question from Rastogi ji to you, Krishna, but I'll try and answer that myself as well. Investor coming to invest in focus fund is aggressive. Then what is the reason of making such a conservative portfolio with more than 70% allocation, which I presume is to large cap?
Hmm.
Uh, Anu sir, like I reiterate, we don't make calls कि a large cap stock is a conservative stock and a mid cap. If I was to just give you an example, and this is a stock example, just a coincidence. Uh, One of the best performing stocks in the top 1,000 stocks, which includes therefore a lot of mid and small cap stocks, in the last 3 years, 5 years, last 1 year has been M&M. It's a large cap stock, right? it Think about the businesses that Mahindra and Mahindra Limited is into. Basically, it is into automobiles, as is most people know. It is also into farm equipment, but it is also into renewable energy. It also is the holding company for hospitality business, real estate business, financial services business, tech business. So it's you would to describe it as a conservative company would be, I think, in some sense injustice, right? Just to give you a second context, our return in the focused fund today, it's not 70% large cap. In the last 3 years, our average large cap has been 60%. But our focused fund has provided a 3-year return, which is better than 75% of the multi cap funds in the industry, right? So, my request would be you should trust us to make the right decision. We are not wedded to large cap, small cap, etc. It's a question of our job is to make money for investors. Our job is to be truthful to what we see in the market. If we believe that there are large cap companies that do make sense, we make that call. It is not a conservative call. I can just leave it close with that comment. Anybody who's investing in equity as a fund manager, I'm not talking about your client, right? We are optimistic people by nature. हम कोई स्टॉक लेते हैं तो कॉन्जर्वेटिव कॉन्सेप्ट तो नहीं हो सकता ना, बिकॉज इफ आई बाय अ स्टॉक विच इज 500 रुपीज, आई एम नॉट काइंड ऑफ बाइंग इट विद अ पर्सपेक्टिव कि आई एम ओके कि वो 550 हो जाए. There's always an optimistic perspective. So the bias towards large cap is just a function of growth opportunities seem to be more or less equal across many companies, and then valuation perhaps kind of gives little bit scoring to some of the large cap companies. Uh, Question is for Krishna, but I must take this from Kamalji. With limited cash as shown, can you show the insights on short-term and long-term strategy to improve the performance of Focus Fund? Kamalji, I'm going to give you a shocking answer. I, as the line manager for Krishna, will absolutely refuse to allow him to improve the performance of the Focus Fund. Just to give you context, on a 3-year basis, which is the maximum time frame it is right now, although I know since inception numbers, it's ranked number 4 out of 26 focused funds. We as a firm have no intention to try to be number one, because we know that in trying to be number one, very often you take a larger risk of becoming bottom of the pile. Our role is as many of our funds as you recommend to clients should be in the top two quartiles over 2, 3, 5 year time frames. Now, yes, right. In the last 1 year, the performance has been slightly weak, but that is a function of certain stock and sector calls that take time to work. In the last 3 months, again, it's back to a quartile one performance. So my my humble request would be just have faith that we are our biggest critics, right? So we do not sit and believe ki ठीक है Q3 परफॉर्मेंस है तो क्या हुआ, वी विल कीप trying to look at ways and means to do it. I see Mr. Banerjee has re-put the question because he had stepped out. No, Mr. Banerjee, I had basically said domestic REIT fund now has been, REITs have been classified as equity, and REITs, that given that we have only 5 or 6 REITs, it's going to be difficult to create a fund which only invests in REITs and it's open-ended, therefore guarantees liquidity. I think my mind is it's at least 3 4 years away. Maybe some of my peers may think differently, but we certainly don't think there's enough liquidity for having a 100% REITs fund. There is a By adding Vishal Jaju to multicap, can we expect aggressive returns again from multicap? Well, adding Vishal was because, as some of you may be aware, Manish Lodha is moving on. And Vishal has considerable experience both in his prior jobs as well as here of running multi-cap portfolios. And, as you know, in the small cap fund, he's done what I would believe in a very short period of time, a very, very good job. So, yes, we continue to remain optimistic that we'll do well. Uh, but there is a question on what are you guys doing for the underperformance in large and mid cap, from Vineet Jain Saab. Yes, we have couple of thought processes. I mean, I don't want to hide behind the fact they have underperformed. Uh, I think on mid, part of the reason for underperformance is that we are fairly uniquely positioned in terms of the ownership of mid cap companies we have, which is a good thing, right? Because the last thing you want is you own the same stocks as your competitors, but yet you've underperformed. So we know that there is a bit of uniqueness to the mid cap stocks we've held, and that's starting to pay dividends in the last 3 to 4 months. So to some degree, I think on mid cap we know actions that need to be taken. We've taken them. On large and mid, I think it's pretty much. I think it's the mid cap portion of the portfolio that's dragged performance a little bit, in the sense that mid cap has kind of, depending on the periods you're looking at on the large and mid performance, has underperformed the other two indices, and that kind of, anybody who's run a large and mid cap fund with
Mm.
slightly higher weight to mid cap has effectively underperformed. It's not been a stock call. Bear in mind, the same guy who runs large and mid runs multi cap, and multi cap is doing really, really well. But we'll continue to introspect. I can just tell you, keep the faith. It's. I don't want to. Unlike my answer to focused fund, I'm not going to deny that these funds have underperformed. They have, and we need to take action fairly quickly, which we are. I'm just looking at any other questions. Krishna, which is one sector which you believe is under-owned today but could become a major alpha driver over the next year or two?
No, I guess currently the let's say weakest sectors really, as a generic, I'm saying companies which are exposed to outside India from a business perspective, which can be, let's say, IT on one side, manufacturing exports to other side. That's clearly underowned in the light of this what's happening around tariff. So that can be one space which looks, a relevant option. Again, a caveat being you need some clarity, some sort of certainty on what's going to happen to the tariff rate. So that's unknown. But the sector overall aggregate companies earning from US as a market are interesting.
Okay, Atar was asked. This is a question which I would like to answer, but it is above my pay grade, so I will give it naturally to Krishna. Over the next decade, will India's markets be driven more by earnings expansion or by valuation optimism? And at what point does the story of India as the world's growth engine start getting priced in rather than paid out? Great question, by
Yeah,
the way.
I think that's a that's I to say $1 million or $1 billion question. So I guess there are two parts of it, right? If you just look at pure from economy numbers, more or less we likely to remain one of the very few, or maybe the only economy in the, let's say, top 15 or top 20 economies which are likely to grow at double-digit nominal growth. All your right ingredients are in place. Policy favorables, demography remains highly, I'll say young and nice. So that's why combination of policy environment being favorable and employment generation for demography remains intact. What we also doing right thing is possibly trying to replace some import by domestic productions. Even if I look at pure play GDP equation of export minus import adding value to the country, we're trying to do that. So macro piece is right. If you're going to grow at around somewhere around that 10% nominal, amount of money created in the system is large, and by default, equity markets are going to be a preferred source of investment opportunity for people. So that creates a nice perspective. When does our markets, let's say, top out, or in terms of growth engine starts getting priced in? Uh, I think we as I think one particular person all of us might have read and referred to is Mr. Manish Shokani. He keeps on saying, this decade is something where Indian markets will get into a bubble territory. Again, they're very difficult to define bubble, but my sense is let's wait for that midpoint, or in this journey. In a way, government is trying to do 2047, but our bigger objective or bigger challenge is when do we become something like that, doubling from here. uh, our economy, which is likely to grow towards this 9-10 trillion dollar, to my mind that can be a nice journey, which will possibly create a situation where a lot of the things are being valued and priced in terms of valuation. For now, those things look slightly away in terms of time frame. Even if we grow at this pace, we still have to my mind at least 5 to 7 years journey where Indian markets can remain attractive, especially more for domestic investors. If you look from a global investor, clearly that challenge remains that we are the country where we are growing faster. It's a typical challenge. If I look at from a market angle, what a fund manager might equate a mid cap multiple of 28 versus a large cap multiple of 20 in terms of valuation, something very similar. In the world market context, India is a mid cap country in the sense it's growing much faster than what a lot of other countries are growing at. What sort of valuation one becomes overweight India or not from a global market? That's why requires that multi-country analysis. But from a domestic investor perspective, I guess if I had to put a number, maybe next 5-7 years looks pretty interesting. It's going to be a combination of both earnings as well as valuation optimism.
Okay. I must take a question next from Sakshi ji because she will be otherwise very upset with us. She's asked three questions. And thank you so much for being persistent with those questions. And it is a very interesting question you're asking because Rahul and Krishna and myself on the multi-asset this is precisely the discussion we've been having, which is are there I'll just speak about the question. Sakshi's question number one: are there funds with a variety of metals apart from gold and silver? Sakshi's simple answer: no. Uh, is there a way that one can actually buy metals or other things than gold and silver within any fund? Answer is no and yes, in the sense, and that's where Rahul has been pretty clear that in the last month that gold and silver seems to have rallied too much. And in his view, based on the analysis and the work that we do on our models, it was suggesting that crude could see a bit of a comeback. And it turned out to be a very prescient thought. So basically, what happened is we cut our exposure to gold and silver, which at least in the short term turned out to be a very smart move. If I could have done the second part of Rahul's call, I mean, Rahul could have done, not me. He's the fund manager, which is buy crude. It would have been even better, right? And Rahul has been talking about copper looks much better than it has for a while. And typically, there's a lot of empirical evidence that suggests that typically after a gold and silver rally, the next rally tends to happen in copper. I mean, this is so one of the things that I can commit to you that we are doing. So when we launched our multi-asset fund, we were very clear. Offer document में हम सब कुछ डालेंगे because we don't know कि next 3, 5, 10 year, which if you remember I described this fund ki this is a forever fund, right? So forever में क्या होगा nobody knows. You should create the capability. So our offer document allows us to participate in commodity derivatives. and some of this stuff like copper etc are available as commodity derivatives. So there is a small group in our company that is working on trying to figure out how can we look at introducing commodity derivatives, and if we do, it will be in the multi asset fund, and that would be one place where you'll start to see exposures, not just copper but potentially crude futures, copper futures, zinc futures, so on and so forth. One of the reasons why we are confident we can do it is obviously we are part of a global organization. So within Manulife, obviously we have the ability to lean on commodity experts and get a bit of insights. But for now, we can't do it. We need to figure out how the possible. But it is possible. It's not like regulations need to change, etc. It's a question of ensuring that you work with your custodian, you work with the payment partners within the banks, etc., because it's a different exchange, different settlement. So at some point in the next 3 to 6 months, I think we'll get a better answer on that. Quick question from Mishra ji: should new investors prefer SIP instead of lump sum in mid cap category? Uh, Quick answer: yes. I think mid cap is a space which is boxed in the middle, right? Like Krishna described, 150 stocks. So valuations are pretty rich for sure. Uh, in fact, next month I'm thinking there is I some of you I don't know on this call may have, as you know, I've been for the last 3 months been running a series for many of our MFD partners across the country, which has got nothing to do with Mahindra Manulife or our business or markets. It's really my thoughts and views on how one should grow your business. Uh, Maybe we can do the next webinar really focused on that presentation. Some of you can give your feedback later on. Rather than markets, I can just have a completely different discussion on growing your business rather than ours. Uh, but to that point, one of the points I make in growing your business is that you know try to not worry too much about specific caps. Better solution is try and have a little more trust in certain fund houses. Then you give it to flexi cap, multi cap product or multi asset. We will deal with the pain rather than you having to deal with it. Quick question, Ashok Kumar ji, tell us something about manufacturing in lighter vein. Ashok ji, I would say, आप भी बताइए. Clearly, it's a long-term space. It's not played out in the last 1 year. But in the last 3 to 4 months, there are very interesting things happening in manufacturing space in India. I think at some point there'll be company opportunities, sector opportunities, and market which will recognize it. But if you're asking me, would we expect suddenly manufacturing to be the blowout theme over the next 6 months to a year? I doubt it. There will always be individual companies which will be successes. Manufacturing, to my mind, still remains a 5 year story, and we haven't changed our mind on that. It is not कि NFO कर लिया तो अभी NFO तो हो गया तो now we can tell the truth. ऐसा नहीं है. We continue to believe Indian $7 trillion India's economy will need manufacturing to play a much larger role than it has in last 10-15 years, and that will give opportunities to make better returns than a general equity strategy. That continues to remain our view. Yogendra ji, Rahul, this is for you. Debt funds पे opportunity किधर है?
Well, what we believe is in the fact that long-term oriented debt funds, which is like long duration में opportunity नहीं है, खत्म हो चुका है because 10-10.5% आपको 2 साल में मिल चुका है. अभी opportunity सिर्फ maybe they will launch an income plus arbitrage fund which can shift allocation dynamically. That's one opportunity that I can think through. Otherwise, opportunities only exist in short term and a bit of a low duration fund. But long term funds at this moment is a clear avoid. That's what, or we'll manage it dynamically when we launch our income plus arbitrage fund also.
Yeah. Again, Atharva, given that, okay, my answer on commodities, yeah, his question is commodity benchmark still not fully standardized, long-term price data remains limited. Quick answer, long-term price data is limited in India, but obviously it's a lot more established globally. And bear in mind, we're just discussing, should we have, for example, if we had 22% or 19% in gold and silver, If we have done the work and we believe it's not a bad idea while we're cutting 19% to, let's say, theoretically 13%, right? Where does the remaining 6% go? Can I use 3% to buy some crude futures? Can I use 3% to buy a copper future? That's what we're talking about. And that was my answer to Shakshi. That's the only way in which you may get exposure to other metals. It's never going to be, to my mind, more than 2 3% within a multi asset portfolio. Maybe over time the industry evolves, we create a different product, SEBI permitting. But our relevance of commodities was really just to say that there will be times in which, let me give you classic example, it may never repeat in India's history. 2013, right? You remember we had some kind of a current account deficit crisis. The oil price was seen as the biggest contributor. Fixed income became a major pain point. The 10-year went almost to 9%. Now, logically, at that time, yes, fixed income had a lot of pain, but if you had an opportunity to buy an oil related future, you would have made crazy amount of money, right? So the idea is to equip ourselves with that. It's not really to only do large portions of it. Rahul, anything you would want to add on the commodity side in terms of your thinking? Because given that you're the guy who's really been pushing us as a company to think about it.
Oh, I think Atharvaji mentioned it correctly. We're evaluating both managing risk. That's the most fundamental thing in in commodities, because it's highly volatile, and and you have to manage risk in commodities. And it's unlike any commodity. Commodities per se don't have any cash flow streams attached to it. Let's be very clear on it, and that limits your expectation of returns either way. You cannot guide for a return. How do you chart a return pattern? So it's a tricky thing, and hence we have to evaluate it very carefully. Because we get fully convinced ourselves, but we believe that since, like every asset class, it has cycles. Play into the cycles by in a measured risk fashion, but do not miss the cycles.
So I'm just going to take one final question. I think we unusually have a lot of questions today, but I've realized that we've broken our other promise. First of all, we picked up the 31st of the month to do the monthly call. Secondly, unlike all other calls, we are now at 5:19. Normally we finish by 5. But last question from Samuel Ji, will Indian currency depreciate further and impact on equity markets? I'm just going to give a quick answer. I know Krista has a much more detailed, nuanced answer. In fact, we've been presenting this in many other places. It's this is par for the course. I mean, Indian currency will depreciate 3-4% over time. It's all known. I will just change the tack about this. This is going to be. It's really a function of, do FIs feel more positive about India or not? Because we genuinely believe short term direction is somewhat correlated with FI flows. And to that extent, a lot of the work that we've put in suggests that at least the negative FI flows we've seen in the last 12 to 18 months, at least over the next 6 to 12 months, FIs, or let's say global investors, are pivoting slightly away from US into non-US. Obviously, India is a function of non-US. Therefore, the opportunity for us is higher today to perhaps get more money, currency or no currency, than it has been for a while. Like I often say that before you decide, and I'm just giving you contextual, I have to give you a Mumbai example. बिफोर यू डिसाइड कि हमारा ऑफिस कुर्ला में है तो यहाँ पे बारिश होगी, फर्स्ट क्वेश्चन यू हैव टू आस्क कि मुंबई में बारिश होगी, right? So the similar way, clearly emerging markets are getting a lot more attention, which is a good thing. Now, whether India will get the attention like it did 2-3 years ago, time will tell. We believe that clearly at least the trend is neutral at this point. One final thing I'm going to take, because I realize question on our okay, so we have uh, monthly dividend. We've announced monthly dividend. Yes, we've feedback from many of you that can we move to a monthly dividend format in the equity savings and aggressive hybrid fund. So we've introduced that. I think we have to first do the first monthly dividend shortly. Idea is basically, just it's a product add-on that a number of clients have asked for. and therefore we thought it will make sense. Just a point of view, and I know I'm running out of time, but just an interesting thinking, right? We are we have been so used to recommending growth option to clients, logical, because capital gains tax much better. But just think about it this way: last union budget has effectively meant जिसका भी कमाई 25 लाख तक है, 24-25 लाख तक, उसका टैक्स रेट प्रैक्टिकली 10% है. सो दैट पर्सन विल से कि बॉस मुझे ग्रोथ ऑप्शन से क्या लेना देना है, मुझे तो डिविडेंड ऑप्शन में 10% ही देना है. So the many feedback I got from some distributors, this was especially in smaller locations, was as an industry, you guys don't give too much importance to retail investors जिसको dividend अच्छा लगता है. We all understand कि dividend comes from their own money, etc. But घर में थोड़ा बहुत आ जाता है तो you get a feeling कि ठीक चल रहा है. Right? So which is why that lot of that feedback we decided to move to a monthly dividend format in aggressive hybrid in equity savings. So that was the context. Yeah. And yeah, like I said, I mean, retired clients, clients who are in the lower income brackets, clients who are moving from FDs, typically they're used to seeing monthly interest checks, that kind of thing, right? So, like I said, in the interest of time, we have clearly overshot our time, but thank you so much. I I hopefully commit we are not going to call for another webinar on 30th November. And नहीं तो ये ट्रेंड बन जाएगा. And anybody who's attended this call, please give feedback to your RMs. I'd be happy to know whether next month, instead of the business and market outlook, which we can do very briefly, Krishna and Rahul will be there. Do you want us to do a slightly different session with is my unwanted gyan on how perhaps you should think about growing your business? Thank you so much. Take care.
Thank you.